Hi everyone. Welcome to an introduction to management accounting, or the beginning of chapter 10. So we're going to start with looking at the difference between managerial and financial accounting. When we're dealing with financial accounting, we're typically looking at external information. Financial accountants provide information for those users outside of a business, such as your stockholders or other stakeholders that aren't directly involved in the business. When we're looking at managerial accounting, we're looking at internal information. This information is focused on people who work inside of a business. And depending on who's using it, it can be used to plan, direct, and control business operations. If you are at the lower level, it might just be looking at some non-financial data like work schedules, store hours, customer service policies. But then the further up the management ladder you go, you receive more financial data. And you might get to that economic data too that we typically see in the financial accounting. Looking at your financial accounting, again, you're typically giving information on the company as a whole because external users are wondering how the company is doing overall. Whereas managerial accounting, we're looking at specific subunits. At Wesleyan, we might look at how is the education department doing? How is the business department doing? Looking at each individual piece. How is physical plant doing? All of those things. Financial accounting is used to generate information for the general public, and it is characterized by its objectivity, reliability, consistency, and historical nature. When we're looking at managerial accounting, we're typically more concerned with relevance and timeliness. We're not really looking at, is it consistent? Is it 100% reliable? It might just be, we need this information right now. What are our balance sheets saying right now? What's our income statement saying right now? What do we see right at this moment? And then financial accounting is reported periodically. Normally it's at the end of a year, whereas managerial accounting can't wait until the end of the year. If we've got issues going on between our revenues and our expenses, we need to figure that out right now. So it's done whenever it needs to be done. Here's kind of a visual of the type of user versus the information that you need. Again, you can see that we've got this non-financial data, we get to financial data, and then that economic data. And as you get higher in the company, you move towards that financial data and that financial accounting, which is then all up here. Some senior executives cross over, but you're more looking at your investors and your creditors who want that economic data. And this chart is on page 367 of your textbook, and it's just another good key comparative table showing you the key features and how they are shown in managerial versus financial accounting. The next objective is just looking at how do we determine the cost of a product when we are in manufacturing. So if we look specifically at a manufacturing company that produces tables, how do they decide what that table's worth? And what we get into is period costs versus product costs. So what are the components of a product cost? So when we look at the generally accepted accounting principles, or GAAP, they recognize three types of costs that are incurred in the process of making products. So we get our materials. So this is looking at your raw materials. So if we're making wooden tables, that would be, the wood, the direct raw material. There's labor that goes into it, but this is specific labor. So it's called direct labor. And this is the labor that is actually used to transform the materials into the products. So again, if we're talking about a wooden table, who is actually putting that table together? It does not include people in HR. It does not include the manager that's walking around helping people or making sure that people are doing their jobs. It's the employee who is physically putting together that that product. And the example we're using is that table. The labor that we pay for that person is considered a component of a product cost. And then we've also got your overhead costs. So these are indirect costs, such as utilities, that are consumed when you're in the process of making these products. So if you're in a factory and you're trying to put these tables together, you're going to need, if it's here in South Dakota, you're going to need heat, you're going to need light. So those are overhead costs that would go into product costs. Here's a little diagram of how your product costing in manufacturing companies actually works. So we take our cash payments and it gets converted into materials, labor, and tools. So your raw materials, your direct labor, and your overhead. When that happens, this is an asset exchange transaction. So what we're doing is we're taking financial assets and then we're making them physical assets. So this is an asset exchange. We are taking them and we are directly turning them into an asset that we are going to use or sell at some point. And they come up with $1,000 of finished goods. So how do they get that $1,000 of finished goods? Well, add up the 390, the 470, and the 140, and you should get $1,000. When you get that, you can then find your COGS eventually, or your cost of goods sold when you sell it. So if we did 4 tables, we got 1, 2, 3, 4. So we take 1,000 divided by 4, and you should find that each table is worth $250. Accountants will normally calculate this as an average. Maybe one table does take a little bit longer to put together because of whomever is putting it together, but at the ending of at the end of the day, they're just going to divide it and take an average. When these become physical assets, they go into your finished goods inventory. So the finished goods inventory asset account is where this $1,000 will be until we sell the tables. So if we pay for the materials and the labor and the overhead in December of 2020, and we don't sell these tables, we have them in inventory until June of 2021. That means we do not count these expenses until June of 2021. Even if we've paid them, at this point, they are in our inventory asset costs. So then when we finally sell them in 2021, then we put them into our cost of goods sold. So that's different than the components of your period costs. Period costs are just what they sound like. They're going to be those expenses that are they're typically expensed in the period they are incurred. So expensed in the period incurred. So basically this is a very simple version of the matching principle. You get your general operating costs or your normal operating costs, your selling and administrative costs, your interest costs, and the cost of your income taxes. So here's another diagram. When we look at our product costs, all product costs, so your materials, your labor, and your overhead, will remain in inventory until the revenue is earned when it's sold. So it becomes an asset, and then those product costs become your costs of goods sold. So they move from product costs to assets when you have your finished inventory, and then you finally expense them in your COGS. So again, those are not expensed in the period they're incurred all the time unless you sell them in that period. Your period costs go straight to expenses. Again, these are your general selling and administrative costs. They are your interest costs. They are your operating costs and your costs of income taxes. Here's another diagram just to help you look at your cost classification. Again, we're looking at that table. If this is that specific company they looked at was the Tabor Manufacturing Company. We've got $1,000 in product costs between our labor, our materials, and our overhead. So then when we finish those tables, they go into your $1,000 are going to go into finished goods inventory. And then if we sell $750 or so, sell 3 of them, we find that our income statement's going to have $750 worth of expenses under cost of goods sold. We've still got $250 in our ending inventory. And then when we finally sell that last table, that $250 will move to the income statement. If we've just got selling and administrative costs of $200, it goes directly onto our income statement as an expense. There's no stopping at an asset in between. It just goes straight onto the income statement as an expense. So I hope this helped you figure out the difference between period costs and product costs. And the next video, we'll start going through some of the demo problems.